As we move into a new year, certainly there's going to be a feeling for many that they need to recalibrate their thought process and try to gauge exactly what they should be looking at and trading around in the months ahead. Certainly, when we're looking from a commodities perspective, I wanted to specifically look into precious metals because it has been one of the big outperformers over the course of the year. And of course, we want to know whether we're going to see a continuation of that trend or not. So this video in particular is going to be gauging exactly what I think the direction of travel will be for gold and silver, whether we should favor one over the other or move out of them as a bullish theme in the year ahead. So first and foremost, let's look in terms of demand. So what's the big picture in terms of demand for gold, silver? What's going to be driving these moves? And that really gives us the ability to gauge what's good for it and bad for it, right? So gold and silver, whilst they are related, and we do see correlations between the two, they are very different by their nature. Gold is held up as more of an investment, and certainly that investment standing over, say, jewelry, which in the past has been that sort of heaviest weighting behind demand for gold. Investment has really overtaken, and you can see here in terms of the strength of that ETF buying over recent quarters. This hasn't been updated for the fourth quarter because we haven't received that yet, but certainly the influence of the investors has really taken hold of late. So what does that mean in terms of the year ahead and the potential implications for gold prices? Well, it means that sentiment will play a bigger role. It means we could see heightened volatility because if we're seeing people buy and sell according to market conditions, that's going to move prices much more than if people are buying or selling dependent on whether they're about to have a wedding or something like that when it comes to jewelry. So the increased role of investment and ETFs does mean the potential for higher volatility. And certainly we've been seeing that of late, really significant gains at a period that took us up to almost sort of 4,400. We're gaining $100 in a day, that kind of stuff. Look, certainly we're going to see lulls and we're going to see periods of really major volatility, but it's really going to come down to market sentiment. Now, one of the big problems that I see within the current structure of the sort of financial system at the moment is that we've seen a huge amount of debt that's been taken on, and that snowball effect for some of these Western countries' debt means that it's very unlikely we're going to get out of that. People raise question marks around the value of the dollar, the value of treasuries, and therefore people look into gold. So it's really that safe haven play from one perspective. And remember, we have seen all of this talk around an AI bubble, and if it pops, where can you hide? As we see that narrative around the need to get into havens, so you see another theme playing out. So that's really why I see gold as being one of the best options out there in terms of sort of markets to be holding in terms of from an investment standpoint. I think it really straddles the possibility of a risk off move that we see around fears in the AI and tech valuation space, but also the idea of the devaluation of currency, the idea that people aren't necessarily believing so much in US treasuries because they keep issuing more and more of it. We're now seeing the Federal Reserve stepping in to buy up T-bills. Certainly, there is a possibility that we see that continue to grow, whether it's liquidity concerns or whether ultimately things start to turn sour and we see a new bout of QE. All of that really feeds into the narrative around gold strength. In terms of silver, well, this doesn't necessarily break down the sort of areas of that demand, but what this does is shows you the sort of surplus that we have been seeing over recent years, or the deficit, I should say, surplus of demand. So we're seeing this strong demand recently coming into play, outstripping supply. And certainly this highlights the fact that silver has an industrial role as well. And as we move into an era where everyone needs to be self-sufficient, we've got the Chinese against the US when it comes to manufacturing, when it comes to the new wave of technology products that are coming out, EVs and the like, it's all going to be reliant on materials like silver. Now, you could say if silver prices continue to rise, then people will substitute out for other goods. But the kind of goods that they could potentially substitute it out for would be things like platinum. They're much more expensive than silver. So it doesn't necessarily provide much leeway. And therefore, you see the possibility of, as many people have been calling for, a silver squeeze, where people just buy up all of the remaining silver that's available. People are holding on to it from a sort of safe haven perspective. And that role from an investment standpoint certainly has grown over the course of 2025. And as people buy up, essentially hoard it, and then you see the industrial side of it, where everyone is now starting to move towards it. Certainly the US are claiming that silver is now registered as a essentially critical material that they are probably going to want to stockpile. The more people see it as a critical material that is needed from a country by country basis, and you have individuals that are holding it from an investment haven perspective, you're seeing a number of different sources of demand, and supply will not be able to keep up, quite frankly. So certainly you have the basis for strength, and certainly when we see equity markets rolling over or question marks around valuations, you do see that investment side coming into play. In terms of the demand, I've got a chart here that really tries to outline some of the different areas that are likely to grow over the years. Notably, you can see here automotive. I think the EV space is really a key part of this. But like I said, unlike gold, which has a few sources of demand, silver has much more demand from different areas, and the electrification and the move towards EVs. Soon enough, we're apparently going to have robots walking around our house, thanks to Elon Musk. All of these kind of things necessitate silver. And so that also means that the silver story ties into the economic developments in the years ahead. A key chart here is the ratio between silver and the S&P 500, and then gold and the S&P 500. And you can see over a long time frame, we saw underperformance over the period, sort of around 2012 to 2015 and onwards. But it appears to be the case that we've now bottomed out. You can see this big double bottom formation that's taken place over the course of the past decade across both of these charts. It means that we're exiting a period where essentially gold and silver have near enough performed as well as the S&P 500, and now looking like we could enter a period where gold and silver outperform the S&P 500. This is a marked step change, because the S&P 500 is held up as the most consistent market. If you're going to invest, don't invest in single stocks, just stick it into an S&P 500 tracker, and that's going to make you 10-11% as an average year on year. Well, what if we start to see that outperformance coming into play for gold, and the valuation questions coming into play around the S&P 500? That appears to be what is happening right now. And so it points towards a high possibility that perhaps the rally we've been seeing of late in terms of these precious metals isn't about to come to an end, because of course it's been very steep, but instead it could be in a relative infancy. And certainly as you see these potential sort of sparks of demand down the line, whether it comes to monetary policy with the possibility of QE if things start to go south, if you see people flocking out of equities because we're seeing them rolling over around that tech bubble bursting, people essentially starting to try to find other markets to get into, invariably gold and silver find haven demand around that. So there's a number of different catalysts down the line that aren't necessarily playing out at the moment. And certainly that points towards a possibility here that outperformance for precious metals against the S&P 500 is a distinct possibility, with this decade-long bottoming pattern seemingly coming to an end. We've got the relationship here between interest rates at the Federal Reserve and gold prices, and really this highlights the influence of monetary policy. Now, I've got these vertical lines drawn on highlighting the inception of easing periods for the Federal Reserve. And essentially, when you see the Fed start to cut rates, it generally is either the beginning of another bull run or the middle of a bull run for gold. Now, where are we at the moment? We saw the rate cuts coming into play last year, 2024, and we've been rising incessantly since. If you look historically, it's not necessarily the case that the moment that they stop cutting rates, that's suddenly the peak. A lot of the time it will run beyond that. And a lot of the time that will also be associated with the fact that you then see central banks moving into QE. And so I think the balance sheet implications for the Federal Reserve will be probably more important down the line. You certainly have the fact that they have a huge amount of treasuries that needs to be bought up. And if the demand's not there, then you see treasury yields spike. If treasury yields spike, then the cost of borrowing soars and the debt just gets bigger and bigger and bigger. Who's going to step in to provide that demand? Well, most likely it would be the Federal Reserve. Now, who would be making that decision and leading the way? Well, someone new that's going to be appointed by Donald Trump. So the idea that we could see the Federal Reserve stepping in as a buyer of last resort, essentially, in US treasuries is certainly a distinct possibility, especially when the Fed is being headed up by someone that's job it is to keep Donald Trump looking good. So look out for potential instability in the year ahead, particularly around yields and demand for US treasuries, and the question marks around whether the Federal Reserve are going to step in further. The rate cuts that we have been seeing recently have benefited gold, and you can see that in the past, generally that can set off a period of outperformance for gold, which I think is likely to continue. Now, in terms of that relationship between expectations around rate cuts and the price of gold and silver, we can see that here. So this line in terms of the green one is market expectations around where rates are going to be for the April meeting. So the next 3 meetings in 2026. By the end of that period, where are rates going to be? Well, market sentiment around interest rates essentially go hand in hand here with price movements with gold. Bearing in mind, I've inverted it. So essentially, lower rates would be good for the likes of gold and silver. Now, of course, we are now coming into a period where markets are expecting a little bit of a lull from the Federal Reserve. But as I said, things could shape up very differently from how the dot plot is currently looking because of the fact that Donald Trump is going to have someone in charge who will be trying their best to drive rates lower, because ultimately they're going to get the job based on promises that they're going to be easing, and they're super dovish. Make no bones about it. Similar kind of thing here in terms of silver. A little bit of a lag and playing catch up more recently, and that certainly alludes to the relationship between gold and silver, which we'll touch on afterwards. Then you've got the relationship between golds and treasury yields. I've got them inverted here, but what we've seen more recently is that we've essentially, instead of seeing yields rolling over, we've seen yields remain elevated despite the rate cuts coming into play from the Federal Reserve. Part of this will be down to question marks around demand for treasuries. Part of it is potentially question marks around the possibility of a resurgence in terms of inflation. But certainly, if we do see yields coming down, that generally is beneficial for gold. And certainly, if we do see yields continue to rise, you could say, well, the risk-free return for someone in the bond market is going to be so high that it tempts them out of gold as a haven. Instead, people will be looking at treasuries as a haven. That may be the case, but the perceived instability that would come with it, with the rise in terms of borrowing costs around the US, probably means people won't be desperate to be jumping into US associated assets at that time. Then we're talking about the balance sheet implications. I mentioned this before. Essentially, we've come to the end of a quantitative tightening phase. And now, despite the fact that we're only talking about 40 billion from the Federal Reserve, we're now moving into a phase where they're willing to expand the balance sheet once again. It's very tentative in nature. From a historical standpoint, it's pretty much a drop in the ocean. But nonetheless, it is a step change. It is a reversal that does provide the potential basis for a move down the line where it expands and becomes a bigger deal. Certainly, if we need the demand for treasuries, they're likely to step into the bond market if necessary. So wouldn't necessarily say that right now we're going to see this massive resurgence in terms of the balance sheet, but certainly we're starting to take steps in that direction. And in the past, such things have generally been beneficial for gold prices. In terms of the FX considerations, remember the devaluation of currencies goes hand in hand with people feeling like they should go into something that holds its value. Now, the purchasing power of the dollar essentially just continues to deteriorate as gold prices rise. In other words, you would be better off getting paid in US dollars than you would in, say, the likes of you'd be better off paid in gold rather than US dollars, because what you can buy with your US dollars continues to deteriorate, whereas the purchasing power of gold manages to hold up. So essentially, much like how we see the S&P 500 appreciate and we see gold appreciate, we see the US dollar depreciate. But bear in mind that most of these currencies depreciate. That's the nature of inflation. Inflation inflates away the value of your currency. So you could say, well, in actual fact, I'm looking at euro dollar and the US dollar is doing well over this year or whatever. Well, both of them are being inflated away, essentially. So the purchasing power of all of these currencies will continue to deteriorate. And gold, by its nature, has managed to stave off much of that. So it gives a reason why many people will look towards gold as a more secure investment than even a dollar denominated asset. But certainly just holding it in dollars will do you no favors for sure. In terms of if we do see a continuation of the US dollar weakness that we've seen under Donald Trump thus far, particularly in his first 6 months, if we do see that, that also pushes people into something like gold rather than, say, the S&P 500, because as we saw recently this year, foreign investors investing in US stocks essentially lose much of the value of any gains when the US dollar is devaluing, because they see it wiped out from an FX consideration. So if we do see continued downside in terms of the US dollar relative to other currencies, it essentially means that people are going to likely diversify. That could be into regional stock markets, or that could be into the likes of gold. And an interesting chart here. I mean, I haven't brought this up for a while now, and this was something that I was looking at a lot when we saw Trump come in initially. And every time I have looked at it, I've thought, oh, it's held up absolutely perfectly well. But essentially, if you're overlaying the dollar trajectory of Trump in his first term against the dollar trajectory this time around, following the election, how has the dollar done? Well, it's looking remarkably similar, isn't it? And it points towards another leg lower for the greenback. Now, certainly, I think if we're talking about the weakness of the US dollar as a potential driver of strength for gold and silver, you've got to think what would weaken the US dollar. I mean, ultimately, they've come through a period where they've cut rates by and large, and now they're moving into a more cautious approach. The dot plot lays out a potential 1 rate cut for the year ahead. So where's that weakness going to come? Well, it could come, depending how this plays out, when we see a new Fed chair coming in and he brings about a much more dovish outlook and manages to influence members of the committee. Maybe he doesn't. Maybe he or she essentially doesn't hold enough power to sway the members, and they really want to stay steadfast with the idea that the Fed is independent by its nature. And therefore, we don't necessarily see it. And that might be why, if we were to see it play out exactly like we're seeing here in the past, that might be why the expectation of a much more dovish outlook from the Federal Reserve provides downside for the US dollar. But when it actually comes to fruition and we don't actually see those rate cuts coming into play or QE, we could possibly see the US dollar coming back into strength off the back of that. Finally, before we look at the charts, here is the gold to silver ratio. Notably, we can see that we got very stretched in terms of gold price over silver. That's starting to turn now. It's not necessarily to say, oh, look, the industrials are doing well. The demand for silver is going to be massive because the US economy is looking great. The Chinese economy is looking great. Neither are, quite frankly. They're not looking bad. Certainly the US not looking bad. The jobs data certainly doesn't look great. But they're not in a position where we need to start buying metals off the idea that suddenly the economy looks like it's absolutely booming right now. That does provide the basis, of course, for us to focus on the economics. And if we do see strong numbers in terms of, say, GDP and PMIs and things like that, that should benefit the likes of silver over gold. Nonetheless, I think we've got to a relatively stretched position in terms of the gold to silver ratio, and we're starting to see a significant kickback with silver outperforming at the back end of 2025. Does that mean we see a continuation into the next year? Possibly. Look, I mean, I remember recently I was doing an interview on TV. They asked me whether essentially the gold runs over and everyone just wants to trade in silver now. I think it's quite easy to see something that happens over the course of, say, 2 weeks' time and say, that's it. This is how it's going to play out from here on out. And I said pretty much as much. And a day later, gold was outperforming silver. I think they're going to move in tandem to an extent. But generally, when you see very heightened confidence around that trade, around the strength of one market over another, that provides the basis for that trade to sort of play out for a certain period of time. But certainly, much like how much how like when Bitcoin is doing really well, Ether then takes over because people want that next level of sort of risk that they're willing to take on. Silver's very similar. When precious metals are booming, you do expect at some point silver to have this massive catch-up play where people just wanted to move on to the next level of risk in terms of their positioning. And we've been seeing that recently coming into play. Like I said, let's look finally at some charts and then round things up. So first and foremost, here is the US dollar against the gold silver ratio. And what we can see here is in terms of the US dollar, like we've said in the past, dollar weakness benefits gold and silver, but dollar weakness historically here benefits silver more than gold. So in good conditions, typically silver will do even better than gold, even though gold's doing well during that period as well. But you can see here more recently, really rapid moves towards the downside in that gold silver ratio. Then when we're looking in terms of gold itself, let's look in terms of, say, the weekly time frame. Let's just go on to the logarithmic, doesn't really help that much. So let's look onto the daily time frame. So basically, we had this sort of triangle formation. Then we broke out towards the upside, the move up through your 34.36 into the next leg. Strong surge. At some point, you get overextended and you see a bit of a snapback. We did see that. That was around the talk of the US-China trade agreement. And people think, oh, maybe that demand from China is going to dry up. Well, no, it's not going to dry up. Central banks are likely to continue to hold gold and store gold. And most notably, if you keep an eye out on the negotiations between the whole Russia-Ukraine issue, keep an eye out for any announcement around whether the Europeans are going to essentially just take Russian assets and start to redistribute it towards Ukrainian purposes. Because the more we see stories around that, the more people abroad, say in China or in Russia, feel like somewhere like gold is much safer to park their money than to buy assets in the Western world. So since that pullback, we've been climbing higher highs, higher lows. It's a gradual move. If we move back below this swing low, maybe we see a deeper pullback. But I think there's a good chance of what we're seeing at the moment is a sort of consolidation move set within a long-term bull market. We've seen it in the past. You can see here multi-month consolidation. And certainly if we see strength in terms of the US dollar because the Federal Reserve's held off, or if economic data comes in strong and they don't necessarily need to move as much, or if inflation moves towards the upside, then that could provide a hindrance. But I think it's likely to be relatively short-term in nature. I do remain bullish for the year ahead. And I think that we're likely to see dips being bought, as we have seen recently, because we saw this pullback. I said at the time, maybe we could move into a bit of consolidation because it'd been a really strong move that we'd seen over the course of a couple of months, going from, say, 3,300 up to 4,400, essentially gaining basically $1,000 over the course of a couple of months. That calls for a pullback, considering that we're talking about 3,000 odd going up to 4,000 odd. That is not sustainable. You do see pullbacks, and we've been seeing exactly that. Whether we sort of consolidate for a bit as we sort our feet, or whether we see that dollar depreciation coming into play very soon. If we do, then that could cause that next leg higher for gold. Then looking at silver, it's a similar kind of story, but like I said, we've been seeing a really strong catch-up play of late, really steep gains coming into play. We see these consolidation phase, so a wider consolidation phase, sort of ascending triangle, rally, sort of flag formation, rally, now another sort of flag formation. Essentially, it's a case of following the trend and seeing whether we see any signal of it breaking. At the moment, it seems very healthy in nature. From a long-term perspective, you can see it's been an incredible year. And certainly the break into record highs means we don't really have much by way of resistance levels. It's difficult to say we're going to have 12 months of this, right, from here on in. Perhaps we do. Everyone's talking about 100. I think we're likely to see some bumps in the road. And certainly given the fact that we're now in a phase where we could see a bit of a pause in terms of the Fed, does that cause consternation that drives the US dollar higher? Or do we just focus on what could be the outlook under a new Fed chair and we see the US dollar heading lower once again, and that drives the likes of silver higher? That remains to be seen, but I am bullish for silver. I do think, as you saw with the gold to silver ratio, we're seeing that snapback that I think has got further to run. We've got the sort of squeeze in terms of demand because of the fact that from an industrial perspective, there's not really much by way of any way to sort of substitute it out. So we have got that area of demand that gold doesn't necessarily have to the same degree. So long term, I'm bullish for this market. Do I think we're going to see some chop within it? Yes, I do. Look out for movements within yields. Look out for movements within expectations from the Fed, the US dollar, growth numbers around sort of industrial purposes. There's a lot that goes into it. But the underlying themes behind both gold and silver, I think, are likely to mean continued outperformance. And certainly as we move into a year that everyone's starting to really look out and count up all of the potential risks within the markets at the moment that could explode, there's question marks on where we need to be. And I think gold and silver are held up as very, very good examples of places to potentially be to hide out during such weakness. What's notable very quickly, if you want to look at, say, either of these, gold or silver, let's just look at a monthly time frame and look back, right? If we're talking about market sell-off, so we'll be talking about, say, 2020, 2008, look at what happened during some of these sell-offs, right? If you do see collapses, a collapsing equity market, as we saw here in 2008, often you will see gold and silver go with it. What happens if you lose money on all of your positions apart from one? Well, you end up liquidating much of the position you're making money on as well, because you're getting margin called and things like that. So often, even at times that seem beneficial for gold and silver, i.e. times when everyone needs to get into havens rather than equity markets, during those times, often gold and silver will underperform. So be aware of that. Don't think, oh, look, equity markets are crashing, therefore gold should do incredibly well. That's often not how it works out. But the conditions after that, well, firstly, the sell-off is usually nowhere near as big as the equity market, so it protects you initially. And then once we see things settling down and people are feeling a little bit more confident, and particularly the central banks then step in with QE and things like that, that's when we really start to see the bulls coming back into play in a meaningful manner. And you've seen this here, 2008, once we managed to breach through the prior high, then it didn't take long for you to rally pretty significantly. So you're talking about a 75 gain over the next year and a bit. And a similar kind of move here in terms of the post-pandemic, although we saw a lot of chop because of the whole inflation concerns and everything that came out of that. But ultimately, look at where we are at the moment. So I hope that's been useful. Half an hour. I thought this was going to be about 15 minutes, but lots to talk about. Gold, silver, still going to be absolutely key in the year ahead for 2026. If you like this, make sure to like, subscribe, share it with your friends and more. And I'll be back with more content on some other markets for 2026.